So taxation of real estate. And realistically, we're talking mostly about taxes when we sell, but we do talk about two different types of taxation here in the class. Obviously, we are not tax advisors. We don't give tax advice. If your clients need advice on what they should do as far as should they sell, how much are they going to pay in taxes, you send them to an accountant. That being said, we do want you guys to have a general idea of what are the tax implications of owning real estate and the tax implications of selling real estate. So let's start with the first ones. The implications of owning real estate, and particularly home ownership. So when you own your own property, there are going to be some benefits to that. There are some things that are tax deductible when you own your own home. Some examples of those things, and you don't need to know how to do the math of this, you just need to know some examples of things that are tax deductible expenses when it comes to owning your home. The interest that you pay on any mortgage loan. You not have that one? There you go. Nope, you're fine. There you go. All right, so the interest that you pay on your mortgage loan, if it's your home, that's a tax deductible expense. Discount points. Well, if you think about discount points, they're really just prepaid what? Interest. So discount points are also a tax deductible expense, but they're only tax deductible in the year you purchase the property because that's when you pay them. You pay them all at one time, whereas the interest is going to be an ongoing tax deduction year after year. Mortgage insurance premiums are tax deductible, and usually your loan origination fees are tax deductible in the year that you bought the property. So that's just a kind of a rundown of some of the benefits of owning your own property. In addition to that, even if you don't have a loan, because everything else that we just talked about was related to having a loan on owning your home, your property taxes that you pay on your home are tax deductible against your federal income taxes. So when we talk about all these deductions, we're talking about deductions against our annual federal income taxes. And I almost throw up when I say that because I still have to do my taxes this weekend. Some of us take that whole 6-month thing very seriously. I still have to file mine. So luckily I've paid at least what I think I owe, or most of it, so it won't be that big of a check that I have to write. But I do still have to file them. So I wrote them a big check back in April. I just didn't have time to do the filing. So not like I have time to do it now, but I'm going to have to do it now. So no pressure. Sunday's the 15th, right? So I have till the 16th because it falls on a weekend. I have till Monday morning. That might be my task Sunday night, is finishing my tax returns. But all of those things are tax deductible when you own a home. Fair enough? That's all you need to know about it. You don't need to know how to calculate the tax deductions as a result of owning a home. You just need to know that those are tax deductible expenses. And those are the huge benefits of home ownership as compared to renting. Because when you're renting, people say, when you rent, you don't pay property taxes. Well, that's a load. You do, because you're paying somebody else's property taxes. You're paying somebody else's mortgage interest, but they're deducting those expenses. So one of the major benefits of home ownership is just taking these tax deductions once you own your property, because if you're paying rent, you don't get any of this benefit. Okay? Go ahead. What is interest of mortgages for first and second? So if you have more than what? More than one home, you can deduct the interest on both of them, right? If you had a third one, you couldn't. So just the interest on your first two. And by the way, the IRS is not totally flexible with a lot of things, but the definition of home is one of those things they are pretty flexible on. A home can be a boat. It can be a motor home. It can be anything that has a kitchen and a sleeping quarters on it. So if you have a motor home, an RV, you can write off the interest on that as a second home, for example. Okay? I'm not giving tax advice. I'm just opening your mind. Okay? So now let's talk about the taxes we really care about in this chapter. the capital gains tax. A capital gain is money you made as a result of owning real property. For our purposes in this class. You could also have capital gains on things like stocks and other investments. But for our purposes in this class, it's money you make as a result of owning real property. Well, when would you realize that you made money on real property? When you sell it. So when would you have a capital gain? In the year that you sell the property. And therefore, when would you pay taxes on that gain? Whenever you file your taxes for that year. Does that make sense for everybody? So if I sell a piece of real property in 2017, I'm going to pay taxes on any gain I made on that property when I file my 2018 tax return. Is everybody okay with that? So a capital gains tax is just a tax on profit from selling a piece of real estate. Correct, but you do your 2017 taxes are filed in 2018, right, for 2017. So that's when you would most likely pay the tax unless you choose to send them a check at the sale, okay? So we need to talk about the difference between a short-term capital gain and a long-term capital gain. Y'all notice we went the exact opposite way on the slides here. I tried to make them print better for you all, and that made them show up worse on the screen. So it's like, I don't know which way to go here, but at least they did print nicely this time. So, there you go. So, a short-term capital gain is simply a property that we sell when we've owned it for less than a year. That's a short-term capital gain. A long-term capital gain is any property that we sell that we've owned for more than a year or more, if you want to say it that way. There's a huge difference in the tax treatment here. Huge difference in the tax treatment there. See, when we have a short-term capital gain, that's considered regular income. Regular income is taxed at regular income rates. So for example, if I'm in a 25% or 28% or 30% federal income tax bracket, and I buy a property and I sell it in less than a year, any gain I make on that property. So like, for example, flipping houses, right? If you think about flipping houses, most of the time, how long do they own those properties? Less than a year. So if you watch like Flip or Flop, right? I think the flop part was their marriage reference, but sorry. That was mean, wasn't it? But if you watch that show, all of those properties are going to be short-term capital gains, which means they're going to pay tax on whatever profit they make at whatever their income tax rate is. Whatever, if they're in a 30% income, and they're probably in the 36% tax bracket because they make a lot of money, so they would pay taxes at the 36% rate. Here's the huge benefit of a long-term capital gain. Long-term capital gains tax rates are the same for almost everybody. For almost everybody, that rate is 15%. So if you own that property for more than a year, what's the gain going to be taxed at? A rate of what? 15%. It could go up to 20%, but only people in the top tax bracket, which are people making more than $460,000 a year for a single person, I think is where that bracket falls now. So, I mean, maybe Maryland falls in that bracket, but I do not. So, if you make that kind of money, then yes, you're going to pay a 20% tax rate on capital gains. But the vast majority of Americans would only pay a 15% capital gains tax rate on long-term capital gains. So everybody sees a big difference when you own the property for a year or longer. Is everybody good with that? The difference between the short-term and long-term? No, this is federal. We haven't gotten there yet. There's coming, but we haven't gotten there. We have to talk about a capital gain first, and then we will get to the exemptions. Okay, is everybody good so far? So the idea here is that anytime we own real property, and we're going to just FYI deal with long-term capital gains. We're not going to do any math related to short-term capital gains because everybody's in a different tax bracket. You can't really do math like that in this class. But since everybody, for the most part, falls in the 15% capital gains tax bracket for long-term gains, can we do math with that since it's consistent? Yeah. So that's what we're going to be working on. So when you look at a gain, a capital gain, the formula looks a lot more complex than it is. And you have this in your formula packet as well. This is not the first time you've gotten it. It's in that little packet of formulas you got at the beginning of the class. But a capital gain, remember, it's just the profit you made on the property, right? Now, I want you to relate it to something other than property, because for whatever reason, when we relate things to property, we make it too hard. Think of, I don't know, a car. If you buy a car for $500 and you spend $1,000 fixing it up and you sell it for $3,000, would you say you profited $2,500 because you bought it for $500 and you sold it for $3,000? Or would you say you profited $1,500 because you bought it for $500 but you had to spend another $1,000 to get it ready to sell and then you sold it for $3,000? Which would you say your profit was, the $1,500 or the $2,500? 15. And if you had to pay somebody $200 to sell it for you, would you say your profit was $1,500 or would you say your profit was $1,300? This is the same thing. It's still just what I sold it for, minus what I paid for it. But we've got to adjust those numbers based on money we invested in the property and money we had to pay to get it sold. Does that make sense for everybody? That's all we're doing here. We're trying to come up with how much profit we actually made when we sold this property. That's it. So when you see words like the amount realized and the adjusted basis, don't make them more complex than they are. The amount realized is just the amount you sold it for minus any expenses that it took to get it sold. So like, what would be the biggest expense of getting a piece of real estate sold? Commission. So if I'm looking at my amount realized, it's not going to be the sales price of the property. It's going to be the sales price minus any commissions that I paid and any closing costs I had to pay. Like if I had to pay the attorney or I had to pay excise taxes, or I would deduct all that stuff out and I'd say, okay, well, this is really what I got when I sold the property. Does that make sense? And the adjusted basis, it's what I paid for the property plus any other money that I invested in the property. So like if I put new kitchen countertops in there, am I going to count that as money I invested in the property? Yeah, sure. So does that start to make sense how we're going to do this? It's just what we ultimately got out of selling it minus everything that we invested in it, with the exception of maintenance. We don't count maintenance as an investment in the property. And another thing we don't count when we're talking about capital gains taxes, ignore loans. Anything related to a loan has nothing to do with a capital gain. They just come out in the wash, okay? So we don't care if they borrowed money. We don't care if there's discount points. We don't care if there's origination fees. All those are loan-based things, and we just ignore them because they have nothing to do with a capital gain. Everybody with me so far? Okay? So let's look at an example here. It says Travis purchased an investment property in 2005 for $150,000 and selling it now for $228,000. He incurred closing costs, attorney's fee, appraisal, inspection of $1,500 when he purchased the property, and he's done renovations to the property totaling $32,000. At closing, he's paying a 6% commission as well as excise taxes of $456 and attorney's fees of $400. What is his capital gain on the property? Well, before I even go to the next screen, can you just kind of visually group together the things that go with what I invested in the property? Yeah, what did I invested, first of all, what I paid for it, which was how much? $150,000. What other money did I invest in that property? Closing costs of $1,500, which included attorney's fees, appraisals, and all that. And what else? And renovations. All those are my investment in the property, right? That's called the adjusted basis. The amount realized is just what I sold it for minus any expenses. Well, what did I sell it for? $228,000. And what expenses did I have that related to selling the property? A 6% commission. How about excise taxes? Excise taxes. How about the attorney's fees? Yeah. So when you look at the math, again, we're just going to start filling those things in. The adjusted basis is the $150,000 plus the $1,500 in closing costs plus the $32,000 in renovation. So my adjusted basis is $183,500. Is everybody okay with that number? That's my investment in the property. The amount realized, what I sold it for, what I got out of selling it, is going to be the sales price minus any commissions and closing costs that I had to pay. So I'm subtracting out that 6% commission, which comes up to $13,680. I'm subtracting out the $450 in excise taxes and the $400 in attorney's fees. And if I do all that math, I come up with an amount realized of $213,464. So ultimately what I'm saying here really is that I invested $183,500 in this thing, and I got $213,464 out of selling it. Does that make sense for everybody? We okay with that? If I know those numbers, can I not figure out what my profit was, my gain? Just subtract them. If I subtract them out, my gain is $29,964. $29,960. Now that's the gain, not the tax. That's the actual profit. I made $29,000 on that property. Okay? Could we go one step further and calculate the tax owed? Sure we could. What's the rate that Travis is going to pay on that thing? 15%. So we're just going to take the gain of $29,000, $29,964, almost $30,000, and multiply times 15%, and we would owe the federal government $4,494.60 in capital gains taxes on that transaction. Well, we really don't ever calculate that number.
We just calculate the capital gain.
Just calculate the,
Profit.
that's right, the capital gain as the profit, and then you pay the tax separate from that.
Okay.
Yes,
Is this the
Sean.
same when you're selling like special use places like churches and stuff and schools?
It's the same for all types of property except one, which we're going to talk about in just a second. There's one type of property that gets very special treatment here. Is everybody good on this so far? So let's talk about that one special property that gets special treatment. Your primary residence. Probably the biggest break Uncle Sam will ever give you in this country is the capital gains tax exemption on selling your primary residence.
This is not a one-time deal. You can have this many times.
This is not a one-time deal. You can do it every 2 years. The exemption on capital gains tax on your primary residence. What does the word exemption mean? You don't have to what? Pay. You don't owe them anything if this is your primary residence. It is exempt as long as you don't make a lot of money. Their generosity does know an end, and that you have to know that amount. Where does the generosity end? The generosity ends at $250,000 in gain for a single person, or $500,000 in gain for a married couple. Now you think about it. It's very hard to have more than $500,000 in gain on your home. Very tough. We're not talking about sales price. We're talking about gain, actual profit. You would have to have a heck of a turnaround on a house to do that. Probably own it for a very long time, most likely.
Or a piece of land if you added a structure to it.
Well, that's not going to count. Well, it could. It could be a piece of land that you added a structure to, but adding the structure, that cost all goes in the adjusted basis, remember, because that's an investment in the property. So that's going to come out in the wash of your gain. Does everybody follow that, though? If I sell my primary residence, then the first $200,000 and $50,000 of the gain is, so if I go back to our previous example, how much in capital gains tax would I owe if this were my primary residence? Zero. Because the first $250,000 in gain, well, I didn't even come close to that. I only had $30,000 in gain. So the tax bill would be what? Zero. It would be completely exempt if this were a primary residence. I know it's not because it said what? Travis purchased an investment property. So that's definitely going to be subject to the capital gains tax. So how do we tell if it's our primary residence? The rule is right here on this slide. It is your primary residence, according to the federal government, if you have lived there for 2 of the previous 5 years. If you have lived in that property for 2 of the previous 5 years, you can sell it and take this exemption.
Now, all right, I'm not trying to be stupid, but when they say live, so like, let's say you got a vacation home that still gets mail and stuff to it. You could essentially just buy a whole bunch of vacation homes and keep them for 2 years and sell them off.
As long as you can prove that you've lived there for 2 out of the previous 5 years.
What's proven of living?
What's proving anything with the IRS? I don't know. That's a magic question, right? So they look at.
But also it's kind of like the snowbirds in Florida. It's kind of your residency, your primary. You have to validate that you've been here so many months out of the year.
Sure. And you don't have to. It doesn't have to be 2 years consecutively. As long as you can show 24 months worth of residency in that property for in the last 5 years, then you can claim it as a primary residence. So one thing you could do, if you have an investment property, a home that you own that's got a tremendous capital gain, and you're looking at selling it, and you've been renting it out for the last 8 years, what could you do to avoid paying capital gains taxes on it? You could move into it for 2 years. Rent out your current. I've had clients do that over the years. They come to me and they own, an investment house, and they would have to pay $40,000, $50,000 in capital gains taxes if they sold it. And I look at them and I say, you can save yourself $50,000 by living there for 2 years. And they're like, what?
Done and done.
So you know what they do? They move in. They move in. Absolutely. Because if you can claim you've lived there for 2 out of the previous 5, you're going to be exempt for how much? Up to $250,000 if you're single, and $500,000 if you're married. Now, that married thing is something you got to be careful of. If you have a couple who's getting married and they both own a home, because this happens quite often, they have 2 houses and they're going to sell both and buy one together, they should complete the sales before they get married. Because if they wait until after they're married, they're treated as one unit. They only get one exemption. Whereas if they complete the sales before they're married, they both individually get the exemption.
How long has this been in effect? Like how many years?
A long time. Long time.
More than 30?
Gosh, the Reagan tax overhaul was like 87, so almost exactly 30 years. Okay, is everybody good with this? Understand the exemption? Okay, so on a test, how would you discern which is which? You're looking for has lived in or is an investment home. That's what you're looking for, just to tell you if the exemption's in play or not. Okay? And here's a primary residence example. It says Diane is selling the home that she and her husband have owned for the last 38 years. They originally paid $148,000 for the house and incurred various closing costs totaling $900. Over the years, they've done several major renovations totaling $185,000 in capital improvements. Capital improvements are just improvements to the property. Okay, they count in our investment.
That adds to value.
That does add to the value.
If you do what you think's an improvement, but it's not to everybody else, it's not adding value, right?
Right. But you can count it for this purposes. And basically anything that uses the word new, replace, new, counts as a capital improvement. But anything that you are repairing does not. So a new roof would count as a capital improvement. A repaired roof would not. New siding's a capital improvement. Repainting's not. They're under contract to sell the home for $752,000 and will pay the listing firm a 5% commission on the sale. Additionally, they must pay state excise taxes and attorney's fees of $250. What will be the capital gains tax due on the sale? So, fair amount of math goes into this. First thing we need to figure out is how much they actually got when they sold the thing, the amount realized. Well, that's the sales price minus all their closing costs. So they sold it for $752,000 minus the commission, which I calculated to be $37,600,
Yes.
minus $1,504 in excise taxes, and I got that by taking the sales price and doing what with it? Divided by 500. And minus their other closing costs. So I come up with an amount realized of $712,000 and change. That's what they sold it for. Now we look at what they invested in it. Well, they paid $148 for it, and they paid some small amount of closing costs, $900. But then they made a huge investment in the property over the years of $185,000. And so if we add all those things together, we come up with an adjusted basis of $333,900. Well, our gain is just going to be the amount realized minus the adjusted basis. So $712,646 minus $333,900. They have a $378,000 capital gain on that property. The question is, how much, if any, of that is subject to the capital gains tax? Well, we have to look and see what kind of property it is. It says Diane is selling the what? Home that she and her husband have owned for the last what? 38 years. Does that meet the 2 out of the previous 5 requirement? And then some, right? So is this their primary residence? Yes. So do they get the exemption? Yes. And how much is the exemption? The first what? $500,000, because they're a married couple. So, since they had a capital gain of less than $500,000, how much of it is going to be taxable? Zero. Zero. So they just walked out of that closing with $378,000 and owe no taxes.
So in this case, the excise tax, rounding it up, probably has no effect on anything, right? You do the excise tax, you gotta round it up to the number.
Right, next whole dollar. Yep.
You don't have to worry about that in this case.
Well, you didn't because there was no tax due. It's not going to impact the final answer that much.
If they were to roll their capital gain over into a new property, they would have to take it out when they sold that other property before they counted their
Well,
profit.
let's hold the horses on the rolling it over thing. Yeah. Okay.
I'm just wondering if you have to pay tax, if you get hit again.
Well, why would you roll it over?
That's what I was thinking.
It'd be silly to, because you're not paying any tax.
Right.
Okay. Is everybody good on this? The exemption? Okay. Understand how it works? All right. Now, next screen. Marilyn knew what was coming.
Actually.
The 1031 tax deferred. Deferred just means delayed. Exchange. The 1031 tax delayed or deferred exchange. Folks, this is how wealthy people become super wealthy people. Because I'm not hating at all. My goal is to be one day.
That's exactly right.
But to understand the vehicle that's being used here, a capital gain is only taxable if you touch the money. You can sell these properties and not pay any tax whatsoever on them, even if they are an investment property. The catch is you can't touch the money. You have to immediately reinvest it. And guess what you reinvested in? Another property. It's called a like-kind exchange. You won't be tested on that, but that's what it's called. That's what the government calls it. A like-kind exchange. So let me explain to you why they do this, why this happens. If I own an investment property, let's say I own a warehouse, okay? And that warehouse generates me a nice little before tax cash flow of $100,000 a year. With me so far? Now that before tax cash flow becomes income to me because I own the building, correct? And what do I have to do on my annual income?
Declare taxes.
Pay annual income taxes, right? Is everybody good on that? So I'm paying annual income taxes, and let's say I'm in a 25% tax bracket. That means of that $100,000, I got to pay $25,000 in taxes. Except I don't want to pay that either. So the federal government will allow me, you remember when we calculated depreciation earlier when we were talking about those cost base? I can take that depreciation even on an income producing property, on my taxes. I can claim, whether it's true or not, doesn't really matter. I can claim that my property has depreciated. And guess what depreciation looks like on your annual tax return? It's a minus. So let's say I have $100,000 worth of income, but I can write off $100,000 worth of depreciation on that property. Guess what my income just became on that property? And guess how much taxes you pay on zero income? Zero. Did I still make the $100,000? I did. Did I pay any taxes on it? Not 1 cent yet, right? Here's the problem from an ownership perspective with that approach. Remember that adjusted basis, the money we've invested in the property? You know what I'm talking about? We just subtracted $100,000 from it because that depreciation is going to subtract from our investment. So what that means is we're avoiding paying income taxes right now, but down the road we're going to pay more in capital gains taxes when we sell the property because we're going to have a bigger gain. Does that make sense? If you're reducing your investment in the property year after year after year, when you finally do sell the property, your gain is going to be much larger. Does that make sense?
Yeah.
Everybody with me so far?
Can the investment property become personal property?
It can. That gets you.
Only if you rolled all your investments into one really big personal house?
You could, in theory. In theory, you can do it. So is everybody with me so far on this idea? I'm taking the depreciation to avoid paying annual income taxes. But that's going to do what when I finally do sell the property? It's going to make what bigger? My capital gain, which also makes the capital gains tax bigger. Is everybody with me so far? The problem with this setup is that there's a limit to how much depreciation I can take on the property. Eventually, I'm going to depreciate it to what? Zero. It becomes useless for me at that point because now any income it generates, I have to pay what on every year? Income taxes. So it's time for me to sell because I've depreciated this thing to zero. But what did I say the problem with selling was going to be? The capital gains tax. Enter the 1031 tax deferred exchange. As long as I'm willing to not touch any of the money from selling that property, I can reinvest all of it in another property. And that other property is going to be significantly more expensive than the one I just sold. And if I have to do multiple properties, that's fine, as long as I reinvest all the money. If I reinvest all the money, I pay no capital gains tax. Now, the idea is that eventually I will pay a capital gains tax down the road when I finally do sell and cash out the money. Does that make sense for everybody? So I'm going to buy a new property. Well, I got a new adjusted basis because it's more expensive, right? And guess what I'm going to start doing with that every year? I'm going to depreciate it every year to offset its income. And since it's a more expensive property, what's its income going to look like? Higher income. So now I've got an even higher income that I'm paying no taxes on every year. And I'm depreciating that. Eventually, do I get that one to zero as well? And then what do I do again? I sell that one. I buy bigger, more expensive, more income. What do I have to do to offset that more income? Depreciate again. And I keep doing it over and over with more and more expensive properties and greater numbers of properties until I die. And here's the real magic in how wealthy people get wealthier. When your heirs inherit that property, guess what tax basis they inherited at? Not the one you rolled forward all those years, but whatever its market value is on the day they inherited it. So they can sell it on day one, and you know what their capital gains tax will be? Because they don't have one. And so you could have owned these properties for 40 years and never paid $1 in income tax, never paid $1 in capital gains tax.
That's brought to you by the Real Estate Money, Washington, D.C.
That is a 1031 tax deferred exchange. That's how it works. The idea is you can't touch the money. When you sell, you can't touch the money, because if you touch the money, guess what you got to do? Pay the tax. If you touch the proceeds of that sale for 5 minutes, you pay the tax. You're not allowed to touch the money. It has to be reinvested. And there are all kinds of rules about how long you have to find it and who can hold the money in the meantime, and you don't need to know all those rules. But you can't touch it. No, you're not. That's a great question. Ashley said, aren't you touching it when you buy a new property? No, you're not allowed to. So that's what I'm saying. It is such a lockdown process that you essentially have to have identified whatever property you're going to buy before you sell the first one. And then the closing attorney who sells the first one for you, they have to be aware of what you're doing, and they have to hold the money in their trust account until you can close on the next one. You literally never touch the money.
And their businesses around.
Oh yeah, there are attorneys that this is all they do is 1031 exchanges. Absolutely. It's a whole area of real estate. 1031 exchange.
It's an investment property. How are you not touching money? You're just using all the monthly.
You're just using the income it generates. That's exactly right. You're taking that original investment and you're just leveraging it over and over and over, and it generates bigger and bigger returns because the properties get more expensive as time goes on.
So does it have to be like property?
Like kind literally means real estate for real estate. Any type of real estate. So you could, that's exactly right. You could be selling a warehouse and buying vacant land. You could be selling vacant land and buying an apartment building. Any real estate for any other real estate is a like kind exchange. Okay? Everybody good on that? That's a 1031 exchange. That's all you need to know about it. Any cash taken out at the time of sale is what? Immediately taxed. Immediately taxed. You can't touch the money without paying the tax. And that's it for the tax chapter. That's a pretty quick one, right? So take out that worksheet that I passed out. It says Tom. It starts with Tom. Tom purchased an investment home in 1990 for $72,000. Paying $1,800 in discount points and $1,350 in other closing costs. He immediately put a screen porch on his home at a cost of $12,000 and a new roof in 2008 at a cost of $9,000. He also renovated the kitchen totaling $34,850, replaced windows for $12,800, and did maintenance and repairs. See, because I know what I'm doing here and I'm going to help you out, when I see did maintenance and repairs, put a line right through it. Because maintenance and repairs doesn't matter. All that new stuff matters. Replace, new. But maintenance and repairs does not compute in a capital gain. He was married in 2007 and sold his house in 2010 for $749,000. Paid a 7% brokerage fee plus excise taxes and an additional $500 in closing costs. He also had a first and second mortgage. And what did I say about mortgages? We don't care. Yeah, don't care at all. He and his wife filed their taxes jointly, assuming he pays capital gains tax at a rate of 15%. How much in capital gains tax is due at closing? All right, so first thing we need to do is calculate the capital gain. That's always step one. And that's going to be the amount realized minus the adjusted basis. Amount realized minus the adjusted basis. I hate when it does that. Ah. There it goes. There it goes. Okay. So what do we start with as far as amount realized? Sales price when he sold it, right? Amount realized is when he sold it. So we're starting with $749. All right. So $749,000 minus any expenses he paid to get the house sold. Well, I would say a 7% brokerage fee would be an expense to get the house sold, right? And excise taxes and $500 in closing costs. I would say all of that matters for the for the amount realized. So 7% brokerage fee, 7% of the sales price. So $749 times 7%, how much is that? So minus $52,430 in commission. Minus excise taxes, and how am I going to calculate the excise taxes? Sales price divided by 500, how much is that in excise taxes? $1,498. And
$1,499.98 as a practice, or just?
why would you put $1,499?
You said round up, always round it up?
Only if you have change. You don't have any change here. $1,498 is just $1,498. Only if you have change, right. There's no rounding if it comes out to be an even dollar figure. Only if you have change. So if it was $1498.01, you would go up to $1499. Okay? So minus $1498 in excise taxes and minus the $500 in closing costs. What do we get for an amount realized here?
So I got a question. Discount points don't matter.
Discount points don't matter. It's a loan expense. It's a loan expense.
$694,572.
$694,572. Amount realized.
I got something different. I got 694, 602. but
602. We'll check.
Redo it. I might have done something wrong.
Did you do 52,430 in commission or 52,400?
52,400.
694,570. Okay. So
Why am I getting it wrong?
are you doing 52,430 in commission?
No, 52,400.
52,430. Okay. All right. So the adjusted basis, what things are going to count toward that?
Improvement?
Well, we got to start with purchase price, right?
Purchase price.
Purchase price. We don't care about $1,800 in discount points because that's a loan expense. We do care about the $1,350 in closing costs. We care about all these improvements. A lot of those. So I got 72,000 plus 1,350. Put a screen porch on of $12,000. Yeah, remember the discount points are a loan expense. $9,000 for a new roof. What else have we got? Kitchen renovation, $34,850. And windows are $12,800, right? The original purchase price, yes. Because remember, stop and think about what you're trying to do with a capital gain. You're trying to figure out how much profit you made. So of course, how much you paid for the thing has to be figured into that, right? Don't lose sight of the forest for the trees here. You know, don't get in the weeds so far that you can't remember what you're trying to accomplish. Okay? So what do we have as far as an adjusted basis? If we add all those together. 140,650. Does everybody agree with that number?
Oh, you're talking about those
For
added
the
up.
for the
Oh,
adjusted
you was
basis.
already
Yep. You're already doing the gain. But for the adjusted basis, did you get 140,650?
All I gotta do is
Now you're at 142.
142? 142 even? Okay. All right. 142, 1350, 34,850, and 12,8. Yeah, that's right.
Wait a second. Wait.
Yeah, because you got 850 and 800 is 1650 plus 1350 is going to put you at an even number.
Why have you got the discount points? And why have you got the 1350 in there?
I don't have discount points in there.
That's closing costs.
That's closing costs. 1,800 in discount points we left alone. 1350 in other closing costs.
That's what I did not have in there.
Okay. So adjusted basis of $142,000. So the capital gain again is just our amount realized minus our adjusted basis. So 694,572 minus $142,000. What is the capital gain on that property? How much? 564, 572. It's all right. That's why we hold it out there. It's like a bid, you know. 552, 572. I need to keep a calculator up here so I can do it too. 552, 572 in gain.
I should have did the adjustable basis first to see what I got.
Now, they want to know how much in capital gains tax is due at closing. But before we can decide how much they have to pay in capital gains tax, we have to decide if any of this gain is exempt, right? And it would be exempt if it was their primary residence. So let's go back and see what it says about the property. Tom purchased an what? Investment home. So is this their primary residence? No. So they're going to pay capital gains tax on this whole thing. So times 15%. And how much tax is owed?
82,885.
$82,885
Right.
and 80 cents.
So the first part that we're looking for is just whatever it took to sell the place.
That's the amount realized. That's right.
So the closing cost doesn't really count as selling, right?
It does. We've got the $500 in closing costs there.
Oh, okay.
Can you leave that right there for just a second?
Sure.
Oh, so the other closing cost is from when it got sold.
It was when we were purchasing it. It's when we were purchasing it. The $1,350 in closing costs.
Yeah.
That's on the purchase side. The big thing here is just group things, purchase versus sale. You know, get them grouped together.
And that's why closing costs would be different than the points or interest.
Right,
or whatever.
because closing costs relate. The idea here is that anybody would have to pay the closing costs. Anybody would have to pay for those, whether they had a loan or not.
Yeah.
But we don't want to include the loan-based expenses. Yes, Rachel.
So if it had been residential, since they make 52,000 more than 500 and they filed jointly, they're not exempt either.
Well, let's talk about that. Look at
Or are they only exempt up to 500?
Look at question number 2.
Oh.
It's a good question, ain't it? No, it is a good question. We get ready to do it. So,
And that would be,
If they, this was their residence, since he purchased it before they were married, is it only his exemption?
no, they get it together. Once they get married, they get it together. Yep.
and if she was the tenant that he married in 2007, then,
Still.
no.
What now?
If he married her in 2007, who was the tenant of his investment property.
Oh, and they moved into it? You
No, no,
mean?
no. Let's say his investment property, let's say she was a tenant.
Okay. What's that?
Because she lived there.
Right, she lived there,
Right.
and he married her in 2007.
Oh, could they take it immediately, you mean? Could they take the...
It
Because
would
it
go
was
from
her primary
investment to-
residence
right.
for 2 years?
No, yeah, they could probably sell it immediately in that case and take the exemption.
Really?
Yeah, probably.
So I got a question.
Yeah.
The fact that they put file jointly is a big part too, right? Because you have to file jointly with your wife.
Right. Right. But it doesn't matter filing jointly doesn't matter in this question because there's no exemption. Filing jointly would only matter if it were exempt in the first place. Okay? And we know it's not because it says investment home.
Oh, okay.
It's not their primary residence. The word investment tells you it's not. You don't understand question number 2. Answer.
No, because I was gonna ask.
Right. Answer the above question based on the new assumption that Tom and his wife lived in the home as their primary residence. So, if it's their primary residence, is it now exempt from capital gains tax? The first $500,000 is because they're married, right? So, we have to look at the original gain, which is $552,572, right? And subtract the exemption amount, which is $500,000. So their taxable gain is $52,572. And they would pay capital gains tax at the same 15% rate. So they would only pay taxes on that amount of money. And how much does that drop their tax bill to? Is there a pretty substantial difference between $7,800 in capital gains taxes and $82,000?
Yeah, this is where you'd say, like, it's better to move in before you sell it.
Absolutely. That's exactly what I was talking about earlier. This is the one where you tell them, move in. You're going to save $75,000 in capital gains taxes. Move in. Okay? And so then number 3 and number 4 are actually not tax math questions, but I give them to you here because it's the most logical place to put them because we've talked about every other aspect of investment at this point. They are profit and loss questions. If you go back and look in your formula packet, you don't have to because I'm going to draw it here for you in just a second. If you look in your formula packet, you will see the formula for profit and loss looks like this. Dollar profit or loss, depending on what you're working with, divided by original investment equals rate of profit or loss, depending on if it's a loss. That's your profit loss formula. And this works anytime. Profit and loss can be referred to in a bunch of different ways. Rate of return. What's my rate of return? That's the same thing as a profit. It's always going to be how much you made in dollars divided by how much you invested. Is everybody good with that? How much you made in dollars divided by how much you invested in the property. Well, anytime you're calculating a rate, what do you always have to do with your final answer? Multiply it times 100, right? Anytime you're calculating a rate, you're always going to multiply it times 100. So look over at the worksheet that we were just working on in number 3. It said Bill originally invested $42,000 of his own money in his first home. Over the years, he bought and sold many properties, never dipping into his pocket for more money. So that means he's probably doing what? Just selling drugs. I love that answer. He's doing 1031 exchanges, right? He's doing these 1031 exchanges. But he originally invested $42,000 and he never pulled out any more money. He sold them for a total of $847,000. What's his percent profit on the sale? Well, look at the formula. I'm sorry? Well, there I just wrote it down for you. If you look at the formula, which disappeared for some weird reason. Dollar profit or loss divided by original investment equals the rate of profit. What are they asking us for in this question? The rate of return or rate of profit, right? So all we need to know is the original investment and how much profit he actually made. Well, if you look at that question, don't they give us the original investment? $42,000. They just give it to us. I'm sorry? $42,000 is what he invested. And what did he get out of it when he sold? $847. Now, is that his profit? No, that's what he got total. How would you figure out his profit? Subtract the two. He sold it for $847. He invested $42,000. So his profit is what, $805? $805,000 in profit. Well, the T-bar says the rate of profit equals dollar profit over original investment. And that'll give us our rate. So, dollar profit, $847,000 divided by what? What's our original investment? $42,000. And when you're what does that answer does that give you there? 19 point what? 17. That is not percent. When you're calculating the rate, what do you always have to do? Multiply times 100. What is his rate of profit? I think it's 1917%. Oh, sorry, I just wrote down the wrong thing. Sorry, 805. Thank you. 805. Yes.
I guess where I'm at, I'm trying to work on reading the questions, and when I look at this question, it looks like those are two different things. When it says 42,000 for his first home, right? And then after that, he bought and sold many properties. So I'm thinking the many properties is not the same as his first property.
It was an investment.
Right. It's an investment, and he's just rolled it forward. It says at age 65 he sold 12. I mean, where else would you get the numbers?
Reading too much into the question. I'm trying to figure things out. They're not there.
Yeah, you trying to do Sanskrit back there or something with these things. I'm not.
He bought and sold many properties based on that original.
That's right. That's exactly right.
We're saying,
Right. That's exactly right. He's just rolling that investment forward.
the key word is never dipping into his pocket, stuff like that.
Right. But anytime you're talking about profit or loss, it's always just going to be your profit divided by your original investment. What you made divided by what you invested. Annual rate of return would work the same way. You know, if I wanted to calculate an annual rate of return, I would divide my before tax cash flow, that's my annual profit, right, by what I invested in the property. That would be my annual rate of return. Math works exactly the same. Number 4. Work on that one. Sally sold her home for $105,000 in 2011. She had purchased the home in 2003 for $118,000. What was her percent gain or loss on the property? Is that her investment? Okay? First of all, is this a gain or a loss? It's a loss. She sold it for less than she paid for it, right? We do the math the same way, though. Still going to be $118,000 minus 105. I've got a $13,000 loss. Looking for something?
Yes, I'm trying to be invisible, I'm sorry.
What you need?
I need structural evaluation forms, can you use them all?
Yes, I gave out the last one. There might be a blank one on my desk, maybe. Why don't you? Go in and log into mine. Yeah, we'll log into it. All right, so that's a $13,000 loss. What's our original investment? $118,000. We paid $118,000. So it's going to be $13,000 divided by $118,000. And what does that equal? 0.110, and if I multiply that times 100, that's an 11% loss.
So they wouldn't put it as a negative on it.
No, they would just say loss.
Oh, yeah, because I did that as a negative.
It would just say loss. Okay? How about number 5? Looks like to me $20,000 divided by 80,000, which is a 25% profit. Good? That's it. That's it.